Are you someone that likes to catch the latest blockbuster as soon as it hits the theatres? Then this news may concern you. Now, we all know that OTTs are giving the silver screen a run for its money, but soon you may have to do a bit of running yourself. Now, this is if you intend to catch the latest flick in the theatre near you. Now, this is because PVR, in its latest announcement, has decided to shut down around 50 theatres in the next 6 months. The multiplex major said that either these screens were operating on a loss or were situated in malls that had reached the end of their life cycle. Remember, this comes at a time when PVR-Inox's Q4 net losses have tripled to 333.37 crore rupees. This is the first time the merged entity is reporting its numbers. But it was only last March that PVR as well as Inox had announced that mega merger. This, remember, was making it the largest multiplex chain in the country and also committing to jointly introduce about 168 new screens. Now, seems like those plans will perhaps have to be put on hold, with a reschedule in the handover of these new screens to the next calendar year. Well, we do know that the pandemic has pushed consumers to seek entertainment options perhaps at home, and players like PVR are still struggling to lure back moviegoers. However, PVR's revenue from its operations in Q4 has doubled to that of 1,143 crore rupees. But the low occupancy as well as underperformance from Hindi cinema as well as relatively fewer releases from Hollywood is what has really built the pressure on the business. The company, however, is keeping its fingers crossed, hoping that the situation will ease out by FY24. They say that they are making these adjustments in response to see how the box office recovery really plays out instead of proceeding with their expansion plans.
PVR has been around for 25 years. Inox has been around for 20 years. So there's a lot of properties which have come towards the end of their lease. And also some of the malls have become dilapidated, and those are not as attractive as when they were earlier. So there's no point continuing with those screens. So there's 17 odd properties which totaled about 50 screens are the ones which leases were coming to an end, and they did not have any life left in them. So I think that always happens after some time when the business reaches its maturity in any retail business. So you need to have units which are all profitable.
For now, PVR may be looking to shut down these screens as a move to narrow its losses. A day post its results, the stock too is trading lower by over 2%. And while the road to a full house recovery seems far, all we can say is that picture abhi baki hai.